The MPC also noted that growth outlook remains resilient, supported by domestic drivers, despite weak demand. It is likely to get further support from a favorable monsoon, lower inflation, monetary easing, and the salubrious impact of the recent GST reforms. However, growth continues to be below our aspirations. Even though the growth projection for the current financial year is now being revised upwards, the forward-looking projections for Q3 and beyond are expected to be slightly lower than projected earlier. This is primarily due to trade-related headwinds, despite being partially offset by the impetus provided by the recent GST reforms. Summarizing, the MPC concluded that there has been a significant moderation in inflation. Moreover, the prevailing global uncertainties and tariff-related developments are likely to decelerate growth in H2 this year and beyond. The current macroeconomic conditions and the outlook has opened up policy space for further supporting growth. However, the MPC noted that the impact of the front-loaded monetary policy actions and the recent fiscal measures is still playing out. The trade-related uncertainties are also unfolding. The MPC therefore considered it prudent to wait for the impact of policy actions to play out and for greater clarity to emerge before charting the next course of action. Accordingly, the MPC unanimously voted to keep the policy repo rate unchanged at 5.5% and also decided to retain the stance at neutral. First of all, growth. Economic activity has remained resilient, with growth of real GDP surprising on the upside at 7.8% and GVA at 7.6% for Q1 this year. As suggested by high-frequency indicators available so far, domestic economic activity continues to sustain momentum even in Q2. Looking ahead, an above normal monsoon, good progress of Kharif sowing, and adequate reservoir levels have further strengthened prospects of agriculture and rural demand. Buoyancy in services sector, coupled with steady employment conditions, are supportive of demand. This is expected to get a further boost from the rationalization of GST. Rising capacity utilization, conducive financial conditions, and improving domestic demand should continue to facilitate fixed investment. However, ongoing tariff and trade policy uncertainties will impact external demand. Prolonged geopolitical tensions and volatility in international financial markets caused by risk-off sentiments of investors pose downside risks to the growth outlook. The implementation of several growth-inducing structural reforms, many of which were announced by the Honorable PM on 15th August, including the streamlining of GST, are expected to offset some of the adverse effects of the external headwinds. Taking all these factors into account, real GDP growth for this year is now projected at 6.8%. This is a revision from our earlier forecast of 6.5%. Q2 now is projected at 7%, Q3 at 6.4%, Q4 at 6.2%. Real GDP growth for Q1 next year is projected at 6.4%. The risks are evenly balanced. India's current account deficit moderated in Q1 this year to 2.4 billion US dollars or 0.2% of GDP. This is in comparison to 8.6 billion US dollars or 0.9% of GDP same period last year, on account of an increased net services surplus and strong remittance receipts despite higher merchandise trade deficit. During July and August 2025, for which we have data till now, merchandise trade deficit continued to remain elevated, notwithstanding rising global trade uncertainties. India's services exports, driven by software and business services, witnessed robust growth in the last 2 months, July and August. Furthermore, robust services exports coupled with strong remittance receipts is expected to keep the current account deficit sustainable during this year. On the external financing side, net FDI reached a 38-month high in July this year, driven by increased gross FDI and a moderation in repatriation and outward FDI. Net FPI, however, recorded outflows of 3.9 billion US dollars this year so far. We have data till September 29. This is on account of both equity and debt segment outflows. As on September 26th, this year, India's foreign exchange reserves stood at a healthy $700.2 billion, sufficient to cover more than 11 months of our merchandise imports. Overall, India's external sector continues to be resilient, and we remain confident of meeting our external obligations comfortably. Notwithstanding the robust domestic macroeconomic fundamentals, the rupee has witnessed some depreciation accompanied by phases of volatility. We are keeping a close watch on the movements of the rupee and will take appropriate steps as warranted. Now, I have 3 proposals for internationalization of the Indian rupee. We have been making steady progress in this regard. The first proposal relates to permit AD banks to lend in Indian rupees to non-residents from 3 countries, Bhutan, Nepal and Sri Lanka, for cross-border trade transactions. Second, to establish transparent reference rates for currencies of India's major trading partners to facilitate rupee-based transactions. And third, permit wider use of SRVA balances by making them eligible for investments in corporate bonds and commercial papers also.